Turning now to this morning's U.S. Bank Economic 360. We know the stock market has seen a lot of ups and downs over the past few years. It seems like bonds have been more steady, but that may be changing. Today we're joined by U.S. Bank senior portfolio managers Mike Denneman and Mindy McLaughlin with some insight on the bond markets. Mike, Mindy?
Thank you, Brian. Good morning, Mindy.
Good morning.
So we know that investors have used bond funds as a safe haven over the last several years. Is that a trend that should continue for 2013?
Yes, definitely bonds have been the preferred asset class in the recent past. A lot of money has moved into bond funds. We have a graphic that illustrates these fund flows. Really, since 2008, what we've seen is more money has gone into bond funds than into stock funds, a lot more. But really more recently, probably due to declining interest rates, as well as, quite frankly, investor confidence improving, we've seen investors also take some money out of money market funds and move them into both stock and bond funds.
Okay, so investors are clearly trying to play it safe with the bond funds, but there are risks to investing there that should not be overlooked, correct?
Absolutely. There are a couple. Most recently, investors, I think, have noticed that as interest rates have fallen, the income that they're earning from their bond funds has also declined. But probably an even bigger risk that we're concerned about is that as interest rates rise, and they will at some point, bond funds can suffer principal losses.
So losing money on a bond fund, that's not something people expect. How would you find that happening?
Sure. Well, bond funds, the bonds actually never mature, unlike an individual bond. So a lot of people aren't aware of that. And what can happen is as interest rates move, as the Fed begins to get more active and interest rates rise, you can actually suffer principal losses. We have a graphic that will show you the impact of rising interest rates on bond funds. For example, a lot of bond funds that may be invested in bonds that have a 10-year average maturity, what happens there is if interest rates were to move up by about 2% or 200 basis points, the fund could actually suffer about a 20% decline in principal value, or worse if it's an even longer term fund.
Sure, so that's a pretty significant loss for what's a safe investment.
Absolutely.
Knowing that, how does an investor protect themselves from this loss?
Sure, there are several things that could be done. One option might be to move from longer term bond funds into shorter term bond funds. A second solution may be to move into more diversified bond funds to give you just some exposure to other asset classes. A third thing might be to move into individual bonds. And then finally, what we're seeing is some opportunity in the stock market, some very high quality blue chip stocks that actually pay dividend yields higher than what you might get in a bond fund. So, you know, it's not a one size fits all solution. Each investor has their own unique income needs and risk tolerance, so we would recommend that they seek the advice of an investment professional before doing anything.
Well, great. Thank you, Minnie. That's good advice on investing wisely.
Great. Thank you.